The treasury yield is down quite a bit in the last, let's say, month and a half or so. And our portfolio has done pretty well in that same period of time. I want to discuss this relationship. I'm not sure if there is one, but there's definitely some traces of a relationship. And it goes back to an episode I recorded maybe about 2 weeks ago, where I said we have a fundamental change in the value trade back to growth. I think it's in line with that, and I just want to relate to that discussion and discuss the recent developments, in particular the drop in treasury yields as a big event in the markets. This is the Not Even Wrong podcast. It's July 8th, 2021. This is Krim Delco. Since the last update, the market is roughly flat, and we are down 8.5%. For the year, we are down 20 basis points. The market's up 15.5%, but underperforming by 15.7%. The market is still open. These numbers could change. So I want to discuss the yield curve in particular, and then relate that to our fund and how we think things are lining up here. So the yield curve has kind of looked very interesting this year. First, it was roughly flat. Then it started steepening with the long-term yields, the 10-year and the 30-year going up. And recently it's come back down again, and the yield curve is kind of flattening again. Now, this has several interpretations. A flattening yield curve is always a bad sign for the markets because it prices in less growth, more scare. Short-term interest rates should go down to ignite the economy. So that's sort of a traditional view of the world. We had a steepening of the yield curve and quite an increase in yields in the first, let's say, March to May kind of period of this year. And it was driven by the recovery of COVID. COVID was recovering, and we had this general view in the market that things will be better and that we will see growth and inflation, and that people don't want to hold 10-year treasuries at sub 2% if we have inflation and growth and all that type of stuff. This move in treasury inflated the so-called value trade. So basically stocks that haven't done well for the last 10 years. We're talking things like mining, industrials, traditional car companies, all that kind of, all those types of companies. Those stocks have started outperforming all the growth companies, the Amazons, the FANGs, the Teslas, the biotechs, and all these types of companies. So what happened, and we discussed this several times in this podcast before, we had this inflated growth driven by what the Fed has done, driven by the Biden administration's will to print money and all that stuff, and also spend money on fiscal policy. So driven by all of this, the way we started Orange Capital Partners is that we have companies that there's two types of companies that raise prices and companies that raise value. Raising value means I bring better products, better services for less money. And then there's the companies, the inertia companies, the incremental value companies. Those types of companies, all they do is just raise prices. So in an inflated environment like we had from March to May, raising prices was a good thing. You can actually make money by raising prices, even though it's only temporary. You can make money. People started buying those relatively cheap stocks, and they started selling the growth stocks. So if you look at the performance year to date, growth has done pretty pedestrian, and those sort of value stocks, and again, the industrials and all that kind of stuff, they've done pretty well. Now we have a reversal, and it started sort of mid-May. The yield curve started coming down. In particular, the 10-year yield started coming down again from, let's say, 1.7 all the way to 1.3 today. And at the same time, we had growth stocks starting to relatively outperform again the general value stuff. We saw that in our portfolio. Our portfolio was down between 10 and 20% for that period from March to May, and now it's flat. So we had quite a recovery in the portfolio. We're still underperforming the market, in line with also, if you look at, let's say, a stock like Netflix or Tesla, is still underperforming year to date relative to something like a Caterpillar or oil or Ford or stocks like that. So in that sense, we're pretty much in line. The markets are signaling to us what we're seeing in the portfolio. The portfolio is signaling what's going on in the markets. I think there's a nice symmetry here, and this is a good thing. So first and foremost, I think a lot of the narrative around, let's say, China sales for Tesla, or ARK Invest being cornered by the market, or whatever other narrative we could come up with to explain our underperformance this year, actually, in the end, is a big picture view of the world and the treasury, and these types of macro moves, I think, are probably explaining 80-90% of the underperformance that we have in the portfolio today. So that's a good thing, I think, because it means that we shouldn't be spending too much time on the specific news that are driving daily movements in the stocks, that the macro big picture is actually more important. And that also, to us, signals that the actual equity story, that the actual investment thesis and all these things that matter in the long term, that they're still intact. Because if a company is driven by macro, that means the company is doing everything it's supposed to be doing, and the macro is sort of driving the stock. And this is what's happening, I think, what's been happening in the last 6 months in our portfolio. Now, how do we see the macro going forward? We're not a macro fund, of course, so this is certainly not something that we have technology and expertise in. I would say that the risks are certainly a COVID resurgence. We had this state of emergency in Japan today, and the market sold off pre-market and all that. We see some of recovery right now in the market based on that, so that's a good thing. How do we see that now? COVID for us is not a big deal anymore. We think COVID's under control because we have the vaccines, we have the testing technology, we have people just being sick and tired of being scared of COVID. So all these things are good. What's negative is that we still have the lack of government policy that is actually efficient and effective. So we still have this, and you can see this in Japan. I mean, to have a state of emergency in Tokyo and things like that, it's just rubbish, in my view, and it just doesn't make any sense. So I wouldn't bank on policymakers, on authorities doing any better than they've done before. And this goes back to one of the conversations we had on this podcast about what we think has happened in the last 2 years since COVID. And one of the things that has happened is we had a deterioration of government institutions, and I think the health side of the government is also showing signs of just being deteriorating. Now, having said that, I've been traveling recently, traveling in the United States, traveling Europe. Everything was so far pretty well managed, organized, a little bit cumbersome sometimes, a few questions too many asked and all that stuff, but overall pretty satisfactory in my view. The movement of people and goods and money and all that type of stuff is still intact, so that's a good thing, and therefore we believe that we are just hopeful. We don't have, like I said, we don't have technology and expertise to be more firm on that, but we are hopeful that the macro side of things will not deteriorate, so that we still have the potential positive drivers of the macro side, which is disruption, which is fundamentally new concepts and engineering practices with large impact, 10x improvement, 10x lower prices in things like cars, self-driving cars, biotech, life science, digitization of life science. All these things are still drivers of, they're drivers of performance, they're drivers of disinflation, they're drivers of wealth generation, they're drivers of our fund, they're also drivers of a better life for people who are ready to jump on that bandwagon. And just a little anecdote here. I've met one of my friends here, old friends in Switzerland, and he's very negative. He's negative on all these things. He's actually even bitter on all these things. And it just tells me that, look, it's not a foregone conclusion that everybody will profit. And if your mindset is not such that you want to take advantage of these things, then you don't necessarily will not take advantage of these things, and you actually will suffer. And this is exactly what happens to people that are not ready to jump on this positiveness, on this optimism, and this ability to improve lives and improve and generate wealth. So we at Orange Capital Partners, of course, have chosen to stick with, to be positive, to continue being positive, and also to invest our money and our wealth into fundamentally new concepts and engineering practices with large impact, which in particular are Tesla and the genomic and the gene editing stocks in our CRISPR index. So this was just a little side note, just to re-emphasize that it's not a foregone conclusion that everything will be rosy in the future, but there are certain vectors of the economy that we think have enormous potential, and that's the ones that we have invested our capital in. So to summarize, we had a decline in treasury yields, which is a big event for the market. It's driven the outperformance of our portfolio relative to the market. It is driving stocks that have potential for growth and disruption and new concepts and engineering practices, and it's stopping the growth of the value stocks and the sort of just raise the price type of companies. And we believe that this trend will continue. So we see future outperformance of our portfolio relative to the market. So we still think that we can actually make up those 15.5% that we're underperforming for the year, and actually even outperform and still see new highs in our portfolio based on these macro developments and also the specific innovations that our companies are delivering. And just to mention two of those, one is the FST at Tesla, and the other is the great breakthrough that Intellia had recently in their paper, where they showed that they can actually deliver CRISPR technology with lipid nanoparticles to areas that have been very difficult to deliver before, and they also had great efficacy in patient studies. So these are phenomenal news. This shows that we're still on track to actually deliver better products and services at lower prices to customers, and therefore also generate wealth in the way that we want to generate wealth, which is to generate new, to come up with new engineering practices and concepts and generate new products and services based on those concepts, and increase value, lower price, and make better products and better services to everybody. Thank you.